Good morning and thanks for watching. I'm working more on my stock market project today. Subscribe if you're interested in this sort of thing because I work on it every single day. Before I get into what I'm going to be doing today, I'm going to go over the project as a whole, my goals for the project, what I've been working on recently, and then finally I'll get into what I'm doing today and get down to business. This is the outline for the project and the overall goals. So I have two goals. My first goal is to beat the S&P 500 by a significant margin while staying market neutral. So the S&P goes up on average 6% per year. I want to do 3 to 4 times better than that and get 18 to 24% per year. Um, I also want to be market neutral, so I don't want to ride bear trends and bull trends. I want to be reliably getting these returns consistently, regardless of the market conditions. So even if we're in a recession, I should reliably get these returns. Now, in order to do this, I'm implementing a long short strategy, going long on things that should go up and going short on things that should go down. This is the outline at the bottom. Basically, I have data going back to 2011, but you don't want to use all data you have access to. First off, different things move different. So, common stocks like Apple or Tesla have different price movements from ETFs. There's also things like test tickers, which never change in price and you can't actually buy. You don't want to include those. You don't want to include things like penny stocks. And usually you want to use high volume stocks so that strategies are scalable and you can sell them to quant shops and whatnot. You need to isolate a stock universe. Once you do that, you need to create some model to predict returns. So predicting returns relative to the market, relative to sector, Sharpe ratio, something like that. And the final step, once you have a good returns model, is to implement some portfolio strategy on that. Take the output of the returns model and allocate capital accordingly. I'm writing all of this code in Python. So that leads me to my second goal, which is to generalize and open source this code so that anyone can create these sorts of models for themselves. The status of the code right now is such that I'm creating a universe, creating and testing a model, and creating and testing a portfolio strategy, all in about 100 lines of code. So if you're interested in that, go check out the GitHub link in the description. Fork the repository, download the repository. Let me know how it goes. Let me know how I can improve it or what features you'd like to see added. And of course, if you find it helpful, please star the repository, watch the repository, and follow me on GitHub. These things help me raise my coding profile, help me get coding jobs and freelance gigs. First off, the model. So I got a model around the beginning of April that I was really confident in. So I'll talk about that for a second and what's different from my current model. This is predicting the Sharpe ratio over the next 5 days. And the first reason I think this looks good is I'm hitting my metrics. My goals for all the metrics are the values I'm getting for each metric is well above the goal value for each metric. Not only that, but the decile analysis looks really good. The bottom decile, so the lowest 10% of predictions, are giving the lowest performance. Top 10% of predictions are giving the best performance. And also, if I do a walk forward analysis on this model, creating a new model for every year from 2016 through 2025, it never falls below my goal metrics. So the next step was to implement a portfolio strategy on that model. And I found that basically it was really easy. Almost anything I tried worked really well from the middle of 2023. But when I did the same strategy on the full walk forward portfolio, going back to 2016, it failed from 2016 through 2022. But it did do really well in that same region. So I went through, I generated some new models, and then implemented portfolio strategies on those. And I eventually ended up with this, which looked pretty good. I made some corrections to it, and I got this guy right here. So this looked really good. You see the drawdown was consistently under 20%. And the worst drawdown duration was what, 160 days. So um, all of this looked good. But then the problem was I was looking at how do the deciles perform over time. And so you see 2016 to 2019, the bottom decile was performing best, top decile was performing worst or close to worst. Same thing 2020 and 2021. But 2022 through 2025, the bottom decile is performing worst, top decile is performing best. So my conclusion from this is the model just isn't working well on this early time frame. And here, it seems like I did well from 2016 through 2022. That was really I found some portfolio strategies which squeezed out a positive return, but it's just not working well. So I decided I needed something that works better. So this morning and yesterday, I trained some new models just to predict the returns and not the Sharpe ratio. And so these decile charts definitely look noisier than the last model, but that's to be expected because the Sharpe ratio is easier to predict. So now I'm looking through some portfolio strategies with these models to see, does this improve things? So yeah, I thought I did the same portfolio strategy here, but I'm using, so that might be 20 longs and 20 shorts. This is with 10 longs and 10 shorts, but the worst drawdown's 20%, but the drawdown duration here is too long. What is it? 460 days, so almost 2 years. 252 days is how many trading days there are usually in a year. So, oh, but I have spread scaling on. I thought I did a new optimization. Oh, I did. All right, so let's try with these parameters. So just to make sure, the optimization, was on model 28. So so end positions. Yeah, so 10 positions means 10 longs and 10 shorts. Uh-oh, it's using dollar neutral though. So this is optimized from 2015 through 2022. So yeah, let's just try it. So 9 longs, 9 shorts. Rebalance every 2 days. Oh, 8 positions. I don't know if this is going to be a good strategy. Rebalance every 2 days. Hold for 5 days. Look back 120. Buffer multiplier 2.2. Smooth true. Change that to dollar neutral. 0.04 90-day look back. Spread scaling true, 30-day look back, 0.2 floor. So I think that spread scaling is going to be the workhorse here. 30-day look back, 0.2 floor. I need to lower this drawdown period. Alright, so let's do this. But drawdown warning threshold minus 0.1. Drawdown penalty 0.5. What if I run that? So this is that optimized portfolio, optimized through 2022. So you still have a 540-day drawdown duration. But the volatility is still doing most of the work there. I don't know, I'll put this into the PowerPoint. So even on the optimized, if I'm optimizing it to the early years, it still does pretty poorly on COVID. So the spreads already handle it. Spread and volatility are handling the scaling during COVID. So what's the drop we had here? So it dropped from 120% returns to 80% returns. Not that bad. But the fall off only occurred at the end of 2020. I guess I should test forward HRP opt, get 2024 deciles. Model 25. Okay, now information coefficient's doing the bulk of the work. We're getting a lower drawdown. Drawdown duration's about the same. So let's let information coefficient do less of the work. So oh, target volatility shouldn't be 0.06, should it? 2.12. All right, so let's go here. So obviously that looks really good. Hmm. So it seems like spread scaling might be my best bet. But if we look here, oh no. I'm gonna go get some more coffee real quick. Okay, so this is relying on information coefficient is mostly scaling, but it's too aggressive. I don't think the information So if I do 60-day rolling information coefficient, okay, so here I'm relying on volatility to scale down. Yeah, this isn't much better. Okay, so what if I scale this down to just 5 positions? Okay, I'm gonna go to the bathroom really quick. I'll be right back. Okay, so I forgot what I was trying here. Oh, I think just a slightly lower volatility target. So here it would have dropped from 200% profit to 120%. What's the drawdown duration again? Oh, 370 days. So did I lower the volatility or did I just lower the number of stocks? Average effective longs is 3. Yeah, how do I interpret average effective longs? So it's pretty restrictive, but it's still fluctuating. How did it do this year? Hmm. This looks pretty good though. This doesn't look significantly different from the Sharp model though. Oh, but then by the end of the period, hmm. Okay, so I'll get the sharp for each regime. Actually, this middle regime's not too bad because it's really only bad over 2020, and then it's good over 2021. Okay, I think that's it for now. Thanks for watching. Have a good rest of your day. Adios.